As we are all well aware, Vladimir Putin launched an invasion of Ukraine late last month. Conditions on the ground are quite fluid, and I won't pretend to know all the details. What I can say is that as I have been watching the news lately, it's quite obvious that what's happening in my home does not come close to what's happening in the homes of moms, dads, sons, and daughters in Kyiv. And I wouldn't want to trade places with them, and I'm sure you wouldn't either. From a financial perspective, investors had been bracing for a possible invasion for much of February. We saw it in increased market volatility and a drop in the major indexes, though the decline up to the invasion was generally modest. Excuse me, since peaking on January 3rd, the S&P 500 index's peak to trough decline has been 11.9%. This is through February 23rd, according to the S&P 500 data supplied by the St. Louis Federal Reserve. It's the first official correction, which is defined as a decline of at least 10%, since the early days of the pandemic. However, not all of the sell-off can be blamed on the Russia-Ukraine crisis. Investors are also wrestling with higher inflation and talk of higher interest rates from the Federal Reserve. But the crisis at hand has driven sentiment in recent days. Yet strong fourth quarter corporate profits, according to Refinitiv, and the growing economy have cushioned the downside. It has been a powerful tailwind for investors, but not enough to overcome stiff headwinds from geopolitical uncertainty and talk of higher interest rates. I'm going to roll the intro for today's podcast, and then we will take a closer look. The secret to prosperity is not any one thing. The secret is in every decision you make. The Bible calls it steady plotting. I think it sounds like common sense. Join me on this podcast as I try to inspire you to make your next financial decision, and the one after that, a good one. Massing Russian troops along the border of Ukraine created uncertainty for investors. Analysts often say that markets despise uncertainty. We feel that the term heightened uncertainty may be a more accurate description, as there is always some uncertainty attached to investing. When heightened uncertainty arises, it simply means that the number of potential outcomes for the economy is increasing. And in most cases, those possible outcomes are usually negative, even if the odds of occurring are remote. Therefore, short-term investors recalibrate and attempt to discount possible negative outcomes. Over time, the new reality gets incorporated into the outlook, and the focus returns to the domestic economy. That has been the historical pattern. In other words, historically, sell-offs tied to geopolitical uncertainty have been limited. LPL Research has compiled the market reaction to 22 geopolitical, what they call market shock events, going all the way back to World War II. On average, the total drawdown was just 4.6% for the S&P 500. During the Cuban Missile Crisis, the S&P 500 lost 6.6% over 8 days. At the time, the world appeared to be on the brink of nuclear annihilation. The biggest decline in LPL's survey occurred after the surprise attack on Pearl Harbor. The index shed nearly 20% in 143 days, but managed to erase losses completely within 1 year of the attack. How the war affects the US and global economy will ultimately have the biggest impact for investors. What will happen to oil prices? How might sanctions play out? Could we see cyber attacks or a wider war that involves NATO? Will the invasion rein in the Fed's apparent impulse to boost interest rates at an aggressive pace? These are difficult questions to answer. Stocks were priced for perfection heading into 2022. When stocks are priced for perfection and unexpected events occur, we typically see a reset. In this case, a more hawkish sounding Fed and Russia's aggressive posture toward Ukraine provided the perfect pretext for short-term traders to take profits. While we have been due for a market correction, attempting to time such a pullback is all but impossible. There are those who have been calling for a correction for over a year and found themselves watching the major stock market indexes rise to new heights. Besides, if you want to time the market, you must be right twice to be successful, near the top and near the bottom. The smartest analysts have not figured out that equation. And you know what? They never will. Longer term, the biggest influence over stocks is the US economy, the Federal Reserve, and corporate profits, or what we call the economic fundamentals. How the invasion affects consumer psychology will play a big role. Are people going to avoid dining out, or for that matter, skip the purchase of an appliance or a planned trip? It seems unlikely. The direct impact of Russia and Ukraine on the US economy is quite limited. From December 15th, 2021 to February 17th, 2022, just 4% of the S&P 500 firms that conducted earnings calls with analysts, and earnings calls typically follow the release of an earnings report, cited the word Ukraine according to FactSet. By contrast, 72% of S&P 500 companies cited inflation over the same period. Indirect concerns might spring from oil prices and certain commodities Russia and Ukraine export. So, what do we do? Well, control what you can control. What is happening overseas is something you and I cannot control. Maintain a disciplined approach. Your financial plan helps manage emotions. It is the roadmap to your goals. It incorporates the unexpected potholes you will hit along the way toward your goals. Just as it helps prevent you from taking on too much risk when stocks are rising at a quick pace, it also helps prevent emotional decisions that are rarely profitable when stocks are declining. War can take ugly turns, and we are bracing for more volatility. Disappointments could send stocks lower, while positive surprises could boost equities. We won't pinpoint a market bottom, but in the 32 times the S&P 500 index has shed at least 10% since 1980, and excluding the current correction, 1 year after hitting a bottom, the index was up 24.8% on average, and it was higher 90.3% of the time, according to LPL. In the 13 times the S&P 500 has dropped between 10% and 15% since 1980, again excluding the current correction, the average gain from the low after 1 year was 21.9%. The index rose in all but one of those instances after 1 year. We realize that market volatility can be frustrating, but through diversification, active and tactical management, and various other measures, we take steps to help manage risk. When corrections end, the historical trends are encouraging. We understand that news from Ukraine is very unsettling. And while it's very easy to get caught up in worrying about worst case scenarios, it's important to remember the broad historical perspective. I hope I've been able to provide some balance here today. With that, I'd like to wrap this up with something from UBS analyst Art Cashin. Many of you have seen him on CNBC over the years. When Art began in the business over 60 years ago, a veteran trader told him, "The world only ends once. Don't bet on the end of the world. The odds are way against you." As the events in Ukraine play out, we will continue to stay diligent in keeping our finger on the pulse of current events and proactively take action in your managed accounts when we deem prudent. If you'd like to learn more about how we do this, please visit www.smartmixportfolios.com. And lastly, as we look ahead, we are here if you have questions or any concerns. There are two upcoming opportunities that we encourage you to take advantage of. First, our next capital markets update and outlook call. I host this call every month with our Chief Investment Officer, Tom Fox. This is your opportunity to kind of look over our shoulder to see what we're seeing. You'll learn about the positives in the economy and the markets, real and potential headwinds that we're watching, and both our short and long-term outlook. The second opportunity is a special event called Navigating the Not Normal Economy with CNBC senior analyst Ron Insana. As the world grapples with inflation, broken supply chains, confounding markets, political turmoil, and the long-term effects of COVID-19, CNBC senior analyst and commentator Ron Insana continues to be a voice of economic reason. This is a rare opportunity you won't see anywhere else, so I hope you take advantage of it. For details and to RSVP, visit the events page on our website, www.investwithccg.com. From all of us here at Capital Consulting Group, we hope to see you take advantage of these two opportunities. Hey, this is Eric Hagan again. I want to thank you for taking a few minutes with me here today. Did you find value in today's message? If so, please help me help others and share this message. Would you like more ideas for making the most of your financial future? There are a lot of ways, and I'd love to help. Be sure to subscribe here and then go visit me online at www.erichagan.pro. I hope to see you around. Capital Consulting Group Inc. is located at 6640 Shady Oak Road, Suite 200 in Eden Prairie, Minnesota 55344. Telephone number 952-540-0153. Securities and investment advisory services offered through Next Financial Group Inc., member FINRA, SIPC. Capital Consulting Group Inc. is not an affiliate of Next Financial Group Inc. The Dow Jones Industrials Average is a price-weighted index of 30 actively traded blue-chip stocks. The S&P 500 is a market cap-weighted index composed of the common stocks of 500 leading companies in leading industries of the U.S. economy. The information provided here is for general information purposes only and should not be considered an individualized recommendation or personalized investment advice. This material is not intended as an offer or solicitation for the purchase or sale of any security or other financial instrument. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against a loss. This information is not intended to be a substitute for specific individualized tax, legal, or investment planning advice. Neither Next Financial Group Inc. nor its registered representatives or employees provide tax or legal services. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. All the views expressed are those of Eric Hagan and not those of Next Financial Group Inc.